This screencast is a review for Unit 4 AP Macro. In this screencast, we're going to talk about the functions of money. We're going to look at the fractional banking system. We'll graph out money market and loanable funds. We'll tie it in with monetary policy. And then we'll also look at those tools and how they affect the ADAS graph. My suggestion would be to get some paper and something to write with. So that way the different problems that are provided throughout this review, you could pause and then do yourself, and then you can check your answers to see how you're doing. So the first thing that I want to talk about is money itself. Our money is backed by the faith of the US government. That's why it is called fiat money. Sometimes people still think it's backed by gold, but it's not. There's three functions of money. You have the store of value, and this is just how over time money doesn't lose its value. And so a dollar today is going to buy me what it can buy me a week or a month from now. And yeah, there's inflation and things get more expensive, but that's not the point here. The point is that that dollar still has that same value. Unit of account, any questions that you see where it tells you that the cost of something, that is where it's saying how that money gives it this value for its price. And then medium of exchange is what we use money for in order to be able to obtain goods and services. What I want to get into now is the T-chart. When we talk about banks, their whole goal here is to make money, and money is made through loans, which are in our excess reserves. When you have a T-chart, you have your liabilities that's over here on the right-hand side, and you have your assets that are on the left-hand side. The most talked about or used liability are the demand deposits. Another way that they can be referred to are bank deposits or checkable deposits. You also have other liabilities like loans that the bank has taken out itself or owner's equity through the shareholders. On the asset side here, you have your reserves. Total reserves or actual reserves are broken down into the excess and required reserves. You also have your bonds or your securities that the bank owns, and they can sell those to people or to the Fed. Loans that they've already given out, so they've used their excess reserves and they've loaned them out to others. This one here, all banks have to keep money in the Fed. Remember, the Fed's the lender of last resort. And so they've got to have some money there in case if the Fed is going to need to start bailing out banks. But what's important to remember about this is that if I have money in the Fed, that value is part of my required reserves amount. So you know that banks have to keep a certain percentage in the required reserves. Well, if I have some in the Fed, that amount is added to the amount that I also have in my own vault at my bank. So the thing to remember about the T account is that it has to balance. Whatever value I have added up over here on the liability side, I have to have that value added up here over on the asset side. So why don't we take a look at some of different ways that you could be asked questions. So in this one here, this is the simple one where you've got the T-chart and you've got your liabilities and your assets. I think the thing to remember here is that these reserves, these actual reserves, are broken down into the required reserves and the excess reserves. And so I think it's important to make sure you understand how much is really in each of those. So it tells you that you've got a 10% reserve requirement. So what I like to do is I like to, over here, just kind of break down those demand deposits, because the 10% reserve requirement is based off of the demand deposits. It is not based off of 10% of my actual reserves. So 10% of 20,000 is what I have to put in the required reserves, or 2,000. And so that leaves then 18,000 for the excess reserves. Now, if I look over here, I don't have 18,000 even in my actual reserves. And that's because they've already taken some of their excess reserves and they've loaned some out to other people, and they went and they bought bonds. And so what I think is important to do is to break down this to make sure you see how much is available for this bank to loan out. So they have 2,000 that's available in the required reserves, and then of that 18,000 that's left here, they've already spent 12,000, so that means that they have 6,000 that's left in the excess reserves. Another example that can be given to you is about how when people withdraw money from the bank, because not only is that going to change and bring down the amount of demand deposits, but it's going to affect the required and the excess reserves. So again, they've already done $12,000 worth of stuff, and they have 8,000 in their required reserves. So if they take out $5,000 from the checking account, that's going to drop their demand deposits down to 15,000. Things are not balanced over here, right? This is adding up to 20,000, and over here we have 15,000. I can't touch this, and so therefore that means that my reserves have actually gone down to 3,000. Well, I think it's important now to look and see, well, how much do I have in my excess reserves available to loan out? And I have to keep 10% in my required reserves. So if we break down that 15,000, we see that you have 1,500 that is in the required reserves and 13,500 that's in the excess reserves. And remember, they've already done some stuff with these excess reserves already. And so if I look at that 3,000, I have my 1,500 of the required reserves, and the amount then that's left over in order to balance to 15,000 would be 1,500 in the excess reserves. So just good ways to be able to make sure that you're balancing things and not getting caught up when people withdraw from the bank. The other thing that we need to look at here is about when we're depositing demand deposits and the impact that this has on the T account. So in this instance here, if a person deposits $1,000 into the checking account, what happens on the liability side and what happens on the asset side? Maybe you want to pause this for a moment and try this yourself, and then you can check your answer. If you look here, you have a person who deposits $1,000 into the bank, and so therefore the demand deposits are going to go up to $21,000. Well, I've got to balance things over here on the asset side. So what I like to do is, again, you added $1,000 into your demand deposits. And so what that means is 10% of that has to go into the required reserves and 900 goes into the excess reserves. And so when I look at that distribution and how that will affect the asset side, what you'll see here is that you'll have 2,100 in the required reserves and you'll have 6,900 in the excess reserves. You can't change the securities in the loans because those are things that have already been done. When you have somebody deposit $1,000 into the checking account, this causes an increase of 900 into the excess reserves. In the next one, we're going to look at the impact of when the Fed deposits money into the bank and how much that changes the excess reserves. In this case here, you have it where the Fed buys $1,000 worth of securities. How is that going to affect the liability side, and how is that going to affect the asset side? It has no effect on the liabilities. It directly goes, and they're buying it from their securities. So their $5,000 worth of securities, they just bought $1,000 from the bank. So this is down to $4,000. Well, this is not balancing here. So what happens to that $1,000? That $1,000 immediately gets put into the excess reserves. So the difference when you look at what happens to the change of the excess reserves is that when the Fed buys securities, all of it goes into the excess reserves. Where remember, when a person deposits money into the bank, part of it has to be put into the required reserves. And that brings us then to the difference between the monetary base and the money supply. I think what's important to know about this is what the composition or what makes up the monetary base. And that would be the reserves, that the Fed reserves, where I'm keeping money in their vault, my required reserves, and my excess reserves, which add together to make your total reserves, and also the money in circulation. That makes up the monetary base. The money supply is also money in circulation, but it's also your your liquid money, the demand deposits, because that can be easily spent. And so the money supply is made up of those. So when you talk about who impacts what, the Fed can increase or decrease the monetary base when it buys and sells bonds. The banks, when they loan money, that's how they're able to increase the money supply, because it puts more money in circulation and people are depositing that money into the banks. Here are some different problems that we're going to look at when it comes to what is affected with regard to the money supply, the excess reserves, and other parts of the bank. My suggestion would be to write down these different scenarios as I'm going through them, so that way then you can do them ahead of time and then be able to see how you're doing. So again, money is made through loans. When we're talking about how money is made through loans, we're looking at the money multiplier. The money multiplier is 1 over the reserve requirement. And that will be provided to you, or you look at the demand deposits versus those that are in the required reserves, and that will allow you to figure out the reserve ratio. In these cases here where we're talking about stuff, our reserve requirement is going to be 20%. And so that means that our multiplier will be 5, because 1 over 0.2 gives you 5. There's different categories that I want to look at when we're looking at these different problems. One would be about a change in the money supply. When we talk about how to calculate a change in the money supply, you're using the equation of 1 over the reserve requirement times the excess reserves, because again, money is made through loans. The other way that you could calculate the money supply, the change in money supply, is by taking that 1 over the reserve requirement by the amount that they deposit, and then subtracting out the initial deposit. In the examples that I'm going to do, or how I explain things, I'm going to use the first equation here of 1 over the reserve requirement times excess reserves. Another one that we want to look at is how money supply changes based off of the initial deposit, not when we're taking out the required reserves. So for that one, a change in the money supply can be calculated with 1 over the reserve requirement times the initial deposit. We're also going to look at instances where there's no change in the money supply. Things are going to be done, but the money supply doesn't increase and it doesn't decrease. And then the other one that gets asked a lot are different changes in loans. And so I wanted to talk through some of the different formulas that you use for that. So let's take a look at our first example. In this example here, Bob deposits $100 of his cash holdings into his checking account. So based off of that last slide, the first question is, what is the immediate change in the money supply? There is no change in the money supply. That is because this is a change in the composition. It goes from cash to demand deposits, but remember, the money supply is money in circulation and demand deposits, so it's not changing there. The next question is, what is the maximum amount that initially can be loaned out when Bob deposits $100 into his checking account? So when we look at that one, the maximum amount that can initially be loaned out, it's not how much money has been created. You have to subtract out those required reserves from that. And so the required reserves of 0.2 times the initial deposit of 100, that gives you $20. He initially deposited 100, and so therefore the maximum amount that can initially be loaned out is $80. The next question is, what is the maximum amount of money that the entire banking system can create? When it asks you about the entire banking system, it's asking you to use 1 over the reserve requirement times the demand deposit or the initial deposit, because this is the money throughout the entire banking system, not just with the loans in itself. The next question that I have, the Fed buys a $100 bond from Bob, and he deposits it into his checking account. The first question is, what is the maximum amount that the bank can lend out? When we're looking at this one here, the maximum amount would be the initial deposit minus the reserve requirement times the initial deposit. Notice here, I didn't ask you how much money can be created through loans. I asked, what is the maximum amount that the bank could lend out? And so that's where they have the ability to lend out the $80. The next question is, what is the maximum change in the money supply from the Fed's actions? So the maximum change in the money supply, because none of it has to be put into the required reserves, remember they will give the $100 and that then will go in. And so that's 1 over the reserve requirement times the initial deposit. The next one, the bank receives a cash deposit of $100. The first question is, what is the maximum increase in the money supply from the deposit? And when we're looking at when somebody deposits money into the bank, well, that has to, certain percentage has to be taken out in required reserves. And so this would fall here under 1 over the reserve requirement times excess reserves. What is the maximum change in the demand deposits in the banking system? This isn't asking about the change in the money supply. It's asking about the maximum change in the demand deposits. And so that's where you would use 1 over the reserve requirement times the initial deposit. The next question, the Fed buys $100 securities from the bank. The first question is, what is the maximum change in loans from the Fed deposit? So when we're looking at this here, again, what we're looking at is the change. It didn't ask how much could be loaned out, because then it would be the total amount, but it's asking about the change in loans. And so that's where you have to subtract out the initial deposit from that. And so it would be 1 over the reserve requirement times 100, which is 500, minus another 100. And so that would give you 400. What is the maximum change in reserve requirements in all banks? The maximum change in reserve requirements in all banks is going to be all of the money that is changed, because it either goes in excess or required, and then eventually it will all end up in the required as it gets loaned out more and more. So the maximum change in the required reserves in all banks would be 1 over the reserve requirement times the initial deposit. So what I suggest to you is to look at the different ways that these questions can be worded, and then you can see what formula you're using as you're going through. The next thing that I want to talk about is monetary policy. First off, with monetary policy, the Fed has a dual mandate, and it's for price stability, which would be about inflation, and maximizing full employment. When we talk about the 3 tools of monetary policy, if they ask you a question of what tool should the Fed use, and you want to say like increase the money supply, I would talk about expansionary monetary policy. Don't just say they should use monetary policy. Explain if it's going to be expansionary monetary policy or contractionary monetary policy. And then another way to say expansionary monetary policy is to say easy money. And another way to say contractionary monetary policy is to say tight money. And then these are the 3 different tools that go along with expansionary monetary policy, and these are contractionary. Obviously, this is the one that sometimes students will mess up, is the discount rate. That is the interest rate that the Fed charges a bank to take out a loan, because a lot of times people will confuse that with the federal funds rate. And the federal funds rate is the interest rate that one bank charges another bank. All of these tools here, especially the most commonly used one of the open market operations, what they're doing is they're targeting that federal funds rate. the Fed is the lender of last resort. They want banks to lend out to each other. And so that's why they're targeting the federal funds rate with the tools that they use. So let's take a look here. And the first thing that I want you to do is I want you to draw the money market graph. So you can pause this and you can draw the money market graph, and then we'll go through and we'll make sure we've got all of that done correctly. So for the money market graph, when we talk about the axes for the money market graph, you have quantity of money over on the horizontal axis, you've got your title, and then it's really important here to have your nominal interest rate, which is a lowercase I. When we talk about the curves of the money market graph, you have a downward sloping demand for money, and that's labeled MD. And then you also have your money supply, which is vertical, and that is labeled the MS. Again, it's vertical because it's controlled by the Fed. And so they're the ones that are deciding how much money is in circulation. To make sure we have proper labeling here, we've got Q1, you've got a dotted line, and you've got your lowercase I to show that nominal interest rate. Some things that pop into my head when I look at a money market graph. First off, we're talking about M1, money that's liquid. We're talking about money in circulation and demand deposits. The Fed controls the money supply. Again, that's why it is vertical. What we're looking at here when we look at the demand for money is this is showing the opportunity cost of holding money. Because the more money that I hold, the lower the interest rate is. So therefore, it's not as big of an opportunity cost. However, the opportunity cost is larger when interest rates are higher because my rate of return off of investment could be larger. And so therefore, people will not hold as much money. There's different things that shift the demand for money. One of them is income. The more money that people have, the more that they will demand money to spend it. Another one is price level. So that brings us to the ADAS graph. When you have inflation and it is going up, then people are going to demand more money. And lastly, technology. The ability for people to be able to get money faster and spend it allows them to demand money more. Okay, the next graph that we have is the loanable funds graph. So again, pause and draw the loanable funds. So for the loanable funds market, you should have your title and you've got your quantity of loanable funds. But what's important here is you've got your real interest rate. And with that, we're denoting that with a lowercase r. You've got your downward sloping demand for loanable funds, and you have your upward sloping supply of loanable funds. You want to make sure you have your dotted lines in order to show the quantity and also the real interest rate. So things that pop into my head about the loanable funds graph. First off, this is dealing with M2. We're dealing with financial institutions and banks and dealing with your savings and being able to get these time deposits or other forms of investment available. When the Fed increases the money supply, the supply of loanable funds also increases because now you have more money that's available in circulation. The real interest rate affects capital stock. A capital stock is really important. That's your I or IG when we're talking about the different components of real GDP. And so when the real interest rate goes down, that makes these long-term investments for businesses easier to obtain. And so they will increase their capital stock. Same thing with people. That would be more for like mortgages. That would be a long-term investment. But again, capital stock is really important because ultimately that's what can shift out the LRAS or a PPC. And lastly, there's an inverse relationship between interest rates and bond price. Bonds and the loanable funds market, they're two different forms of investment. So see them as substitute goods. And so if you have an increase in the real interest rate, well, that means then that I'm able to get a rate of return that's a good investment. And so if the real interest rate goes up, then my demand for bonds will go down. And so the price of bonds will go down and vice versa. Okay, so now let's get into monetary policy and let's look at what happens when the Fed utilizes one of its tools of monetary policy. I like to go through and I call them trains, but I like to write out all of the different things that are affected, and then you can display that on your three different graphs, the money market, loanable funds, and the ADAS model. So the first one that we have here is buying bonds. So pause for a moment, write out the train for buying bonds, and then show the impact that it has on the three different graphs. When the Fed buys bonds, if they're buying them, when they're buying them from the bank, remember that the securities will go down by the amount that the bonds were bought, and that will then be put into the excess reserves. So buying bonds is big bucks. This is where you have expansionary monetary policy. When you have an increase in excess reserves, that causes an increase in the money supply. Because again, money supply is about money in circulation, and when excess reserves are loans. And so you have more money in circulation now. So with an increase in the money supply, that causes a decrease in the nominal interest rate. That causes an increase in consumption and investment spending. The real focus is on consumption here when we talk about nominal interest rate. In addition, when buying bonds, when the Fed buys bonds, that increases the supply of loanable funds because that money gets put then into the banks to be able to be loaned out. When you have an increase in the supply of loanable funds, that causes a decrease in the real interest rate, which again causes an increase in consumption and investment spending. And the IG there, that gross private investment, is what the real focus is when we talk about the real interest rate. An increase in consumption and investment spending causes an increase in aggregate demand. An increase in aggregate demand causes an increase in price level and also an increase in real GDP. So when we look at then our different graphs and how those come about, you have your money market graph, which is showing that increase in the money supply and a decrease in the nominal interest rate. You have your loanable funds graph, which has an increase in the supply of loanable funds. And you also have the ADAS model, which because of the C and IG, you have an increase in AD. The next one that we have here is an increase in the discount rate. And so let's see here if we can draw our train for this one. An increase in the discount rate is going to cause a decrease in loans given out by banks. When there's less loans, that means that there's a decrease in the money supply. So this is contractionary monetary policy. When there's a decrease in the money supply, as shown by the graph below, you have an increase in the nominal interest rate, which causes a decrease in C and IG. When there's a decrease in loans, you also have a decrease in the supply of loanable funds. This causes an increase in the real interest rate, which causes a decrease in C and IG. This causes a decrease in AD, which causes a decrease in the price level and also a decrease in real GDP. So I do not have here, sorry, a decrease in the supply of loanable funds, but it should be shifted here to the left, and you would have a real interest rate in R2. That would be down here in a quantity that would be lower there. Okay, the next one that we have here is a decrease in the reserve requirement. When you have a decrease in the reserve requirement, that is going to cause an increase in excess reserves. Bank don't have to put as much in their vault, and so they have more that they can loan out. When you have an increase in the excess reserves, just like you had with the buying of bonds, you have an increase in the money supply. This causes a decrease in the nominal interest rate, which causes an increase in consumption and investment spending. When you have an increase in excess reserves, you also have an increase in the supply of loanable funds. That causes a decrease in the real interest rate, which causes an increase in consumption and investment spending. And really, we're looking there at the investment spending. That increase in consumption and investment spending causes an increase in AD, an increase in price level, and an increase in real GDP. Graphically, what we're looking at here is you would have an increase in the money supply, which is going to then show that increase in the supply of loanable funds. And lastly, you have an increase in the ADAS model.